John Stoltzfus, Chief Investment Strategist at Oppenheimer, is joining me now. Okay, so where are you looking for the opportunities amid all this bubble talk and, excuse me, but the roller coaster that is the market right now?
Well, great to be on the show with you today, Contessa, especially on really where the Fed has been so kind to us. Great to hear from the New York Fed and from the Boston Fed today and see the market rally the way it is. We think, where we stand right now, it really is opportunity, not so much to buy the dips wildly, but rather to focus on the babies that get thrown out with the bathwater, those really great stocks that for the moment get thrown down like hot potatoes onto the floor by the traders, the short-term aggressive investors, on any excuse to sell without FOMO in a bull market that continues to appear to be very much intact. So we continue to like infotech, communication services, we like industrials, we like financials, and yes, we do like consumer discretionary. We have been, for a long time, we recommend cyclicals over defensives. That's worked out now for years, as well as for this year itself. We think volatility, part of the story. The big issue is, will the Fed indeed cut in December? We think it does 25 basis points. We call it another down payment by Jerome Powell to let both Wall Street and Main Street know that indeed the Fed is in the process of ending the Fed funds hike cycle that started in March of 2022. So far, what do we have? We have 3 cuts from last year, 2 cuts so far done this year, with 1 more likely to go. We can't help but think that this will, in effect, just lets people know that it may not be lowering rates as fast as many in the market want, particularly leverage players on Main Street, whether it's real estate or people just looking for lower mortgage rates. But we think overall, the resilience in corporate earnings is as shown by the S&P 500, thus far remarkably good, powerful, with a domination of earnings growers versus, I think, just 1 or 2 negative earnings growers among the sectors, among the 11 sectors. And they're to be expected with energy, based on the fact that we're awash oil around the world. But the rest is very good, and so we think stocks have time to move up and heal from the wobble that it had over the course of the last 10 days.
You mentioned consumer discretionary. In all of the focus on whether the Fed is going to cut or not cut, what gets lost is how that affects how consumers see the economy. The University of Michigan just out with its consumer sentiment index, which basically was in line with expectations, and they saw a little bit of a pop, just itty-bitty, post-government shutdown when that ended. If you like all these sectors, infotech, communication services, industrials, financials, and consumer discretionary, what's there left not to like?
Well, I think, for example, we're not hot on real estate at this point. We think that's more a granular story where you want to look at the individual properties. We would also think that related to materials, not quite yet. It's beginning to warm up and gain some favor. I think earlier today it was seeing some favor. But we do think some that have been in the shadows sort of for a while here. Utilities are looking good if the Fed is in the process of reducing interest rates. That trend should help reduce the typical what they call the bond market proxy of the utility stocks. When interest rates are high, their yields aren't as attractive typically, but this would be much more typical, would be much more attractive for their yields. In addition to that, the interim to long-term story for utilities, especially the regulated utilities of the S&P 500, looks good, with prospects for improvement of the grid in the U.S. to provide all that electricity we're going to need.